Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is my good friend Mike McGlone, macro strategist at Bloomberg Intelligence. Welcome back, Mike.
Thank you, Ivan. It's good to be back.
Yeah, always a pleasure having you on, coming down to Wall Street Silver. I wanted to bring you on to talk about all the craziness that's happening in the market, the geopolitical issues. But first, we'll start off with silver and gold. I know last time you were on, and actually the last few times, you kept saying, gold is going to be strong. You don't know too much about silver, but going up, but gold is going to be strong. What are your thoughts now that we are almost halfway through the year? We're in May. Where do you see gold going? Is it still going up higher or is it going to level off?
It's the most enduring commodity I think will continue appreciating this year, particularly when we have a little bit of backup and back and fill in beta. And I didn't say if, that's usually a matter of time. I think we're at the stage right now that copper and silver are catching up to gold and beta. Copper made that new high. Looks like it was a bit dicey and probably more short term than long term. Silver's catching up, but the biggest risk, I think, for to me, the more industrial metals, which includes silver now,
Hmm.
um, copper and base metals, is what's happening in China. You see that from Chinese bond yields, they're declining. I've mentioned that before. It's one of the good indicators of severe deflationary forces versus what they say. Watch what they
Right.
do, watch what the markets do. Um, and the thing about gold is it's still marching higher because who's the best buyer? China, central banks. Yet we still have had kind of flatline, somewhat stabilization of gold ETFs. At some point, oh, that's selling. At some point, those gold ETF outflows should switch to inflows. And I think it's going to take a little backup in beta. And that's the key thing I'm worried about for second half of this year. As we look at the VIX volatility index, it's extremely low.
Wow.
If you subtract out the T-bill rate, the average 52-week moving average of the VIX minus the T-bill rates, which are key things that should be your indications whether you should be overweight or underweight the stock market. It's the lowest since 2007. That was a signal that worked really well for me back then. And you have this almost unstoppable stock market rally that makes me realize, okay, copper's catching up. That's great.
Right.
Silver's caught up. That's great. But did they catch up to something that's going to revert eventually? It will. It's just a question of when. And that to me is the macro big picture. And then we have, so we'll move on from there.
Absolutely. And I wanted to talk to you about Nvidia. When will that bubble pop and what will that do to the
Exactly.
what will that do to the market in general?
So um, that's a good question. It's these things that you remember back from 1999 and 2007
Hmm.
that are just excessive speculation in equities, get a little bit out of hand. It's a question of what spark it takes to revert. So I like to use the lessons of Jeff Booth, and that is rapidly advancing technology. Now, Jeff Booth wrote the book, The Price of Tomorrow, is very much favorable to Bitcoin, very much negative on China. He's been right. I like to point out in that space is BYD is doing to Tesla what Huawei is doing to Apple in terms of rapidly advancing technology. Now that's the macro big picture
Right.
and mass. And I have to go to China because when you talk commodities and certainly when you talk metals, there's pretty significant deflationary forces coming out of China, and bond yields are showing that in China. They're 2.3% 10-year note is 200 basis points less than U.S. So how long and how far Nvidia can go and last, I don't know. But here's the key fact I'll point out of my view is the US stock market as a percentage of GDP is about two times now, market capitalization,
Right.
55 trillion or so. That's the most since the 1930s. So it's silly not to expect that to matter most of everything. So if stock market goes up, inflation remains sticky, wealth effect remains strong. Stock market goes down, it's the opposite. And so that to me leads me to believe as that the Federal Reserve will not ease until stock market goes down because we have inflation above their targets, sticky, and on a 1 year basis right now, S&P 500 is up about 30%. That's a silly environment to expect easing
Yeah,
from
yeah.
from a Fed that's focused on curtailing inflation, which they help create. So to me, that all those dangling carrots of that easing is going to leave the market. That's partly what's helped bidding risk assets like copper and silver. Silver is much more of a risk asset now than gold. And at some point, that to me is, I'll end with this. The key thing is, I think I've mentioned before in the program, is we know the pendulum swung way too far towards recession last year,
Right.
swung way too far towards no recession this year. I think it's just going to swing back a little bit towards the middle and means recession. Eventually, we're going to get one, particularly when you, so I'll end with the key things I'm seeing in commodities. We have deflation, and we have recessionary downward trajectories in demand for diesel in this country,
Right.
downward demand for unleaded gas in this country, and for container boards, corrugated boxes, are all in recessionary trajectories that were very similar to the last ones around 2008.
And that's that's another indicator that a lot of people don't look at. They don't look at all those little things and other things like the like what you were just mentioning. And I wanted to talk to you about oil. Lots of people are even in Wall Street Silver, not only looking at silver and gold, but they're looking at oil and what is happening in the geopolitical issues in the Middle East, everything that's happening with the war in Ukraine. What's your opinion on oil prices now, Mike?
Peak for the year.
Peak
If
for
you
the
want a
year.
clear statement of someone who's willing to take risk, WTI's crude oil's peak this year is 87 dollars and 67 cents a barrel.
Right.
Very similar to $95 a barrel last year. It happened at the same time. Managed money net positions in petroleum, i.e., hedge funds, were really long. About 15% of total interest, open interest, is really long. That's very similar to when it peaked around $95 a barrel last year, right at the end of Q3. So positions got way too long, market spiked and went back down. Now there's reasons for oil to have spiked this year, geopolitics, but I think that's about a $20 premium in the market, as indicated by what's happened to natural gas, the
Right.
collapse in things like corn. These are elastic commodities. So I think crude oil's peaked for the year. I think for it to go higher, it needs some kind of significant supply disruption. Who knows from where and how? And it's just a normal environment. It'll go back down, particularly if beta corrects. So here's the bottom line for crude oil: is the number one force that's pressured crude oil since the peak in 2008 is that excess of supply to U.S. and Canada. It's now about 6 million barrels a day. If you look at crude oil and
Yeah.
liquid fuel production, excess of supply versus demand. That's all has to be exported. Compared to when I was more your age, that was an oxymoron. And at the same time, we have OPEC spare capacity rising to almost 6 to 7 million barrels a day. You see that
Wow.
trajectories. OPEC curtailing supply is keeping prices bid, which is accelerating the main factor that pressures prices in the first place. So I think crude oil can bounce. It needs something. It needs something negative every day out of these global conflicts in the Middle East to keep it up. Otherwise, it's going to go back down. I think it's going to head towards its cost of production. The U.S. is, which is below 50, below 60, around $56 a barrel, and follow the example of what natural gas did to get to its bottom.
Absolutely. Now, interest rates. What do you think the Fed is going to do, Mike? A lot of people online are saying, in the beginning of the year, they're saying, oh, there's going to be rate cuts. And then now the Fed is kind of signaling that it's going to be higher for longer. In the UK, they got down to their around 2% inflation. Supposedly they're 2% inflation. So what do you see the Fed doing in the US? Are they going to cut rates this year, keep them higher for longer? What's your opinion?
I don't think the Fed cuts rates until the stock market goes down and tells them to, because of what I said
Right.
earlier. The highest market valuation to GDP in our lifetimes. And then, of course, we have things like the stock market versus every other stock in the world, the MSCI XUS, the highest in our database, and only by almost 50 years. So the problem is higher stock markets right now, the rise in U.S. stock market right now is keeping inflation sticky and keeping the Fed off the table. Yet the market's priced for easing. So to me, the risk is the Fed will not ease until that happens, and they shouldn't. It'd be silly. And the fact is that interest rates went up on that elevator, and I think they're more likely to go down reluctantly on an escalator, which is the enduring bear market we need to reset things. We haven't had a decent bear market since the bottom to 2009.
Right.
Every single time it drops 20% and 25%, the Fed saves us. So to me, that's what's going to happen. It's overdue, and it's just time. It's a classic end of a cycle, and I like to put it this way. Let's look back at this from the future. We just had the longest period of zero interest rates in history. It got risk assets really well bid. That's supposed to happen.
Yeah.
We haven't reverted yet. And part of the reason we haven't reverted yet is we still have that wealth effect, and we have the most significant amount of fiscal deficit spending ever outside of a war or recession. And it's still the residual effects of these 100-year events, the massive money pump. So to me, it's a matter of time for just some normalization. But that's what I think is going to happen. Is I think U.S. bond yields will follow the rest of the world. So
Right.
China is like 2.3%. Germany's just in a three handle. Greece is in a three handle.
What's Japan
Um,
at?
Japan is point 0.8. It doesn't even have a handle. So that's the thing about Japan. It hasn't handled. And I started trading JGBs in the 90s,
Wow.
Ivan, and I remember everybody was bearish, and we're going to, brights are going to go back up, and that was wrong. So Japan is actually it does. It's 1%
Right.
right now in the 10-year note. So that's been a while we've had a handle.
And a lot of people have been also discussing like what happens if there's like let's say your scenario is saying like the stock market has to go down in order for the Fed to step in and lower rates. What happens if you don't see the stock market go down and it keeps you ripping up higher, but you start seeing bank collapses, or you start seeing because of let's say Bank of America, they have so many unrealized losses in commercial real estate sector, but the stock market is still high. Do you think if you see something like Bank of America or these banks starting to go under, will the Fed still step in at the even if the stock market is high? What will that do to inflation in the economy?
So bank collapses and stock market record highs is typically an oxymoron. It
Right,
almost always happens. You almost need that lower tide, which is what happened when we had those last bank collapses last year.
right,
Tide needs to go out and find out who's wearing clothes. And so but that's one of the number one purposes of the Fed is to come in and help when things get out of hand, like bank collapses, and help
yeah,
keep the system from getting disorderly and be the banker of last resort. So the scenario I think is more likely is we have some normal reversion of very expensive risk assets, and we do get to that normal cycle in history that shows when you have massive pumps in liquidity and get inflation in the back of that, and when you dump that liquidity, you almost get deflation to follow because the base is so high for inflation.
right,
Just a
right,
matter of time it trickles down. So the Fed knows that, but the key thing is they're stuck right now, and partly because they helped boost this market. I think the Fed pivot last fall was way too early when
yeah.
he warned he'd be easing, and the market just does what markets do. And type A um, impatient people, oh, I was priced for six eases. Now we're priced for like two eases. And I've been pointing out since the beginning of 23, Fed fund futures have started pricing for 100 basis points of cuts in 1 year, and it was 2023 that they raised 100 basis points after they were still priced for cuts.
Wow.
So that to me is where the market is. It's one of those unique places in history, and you just have to go back all your lessons. And the bottom line for me is risk assets in the U.S. are about the most expensive since the 1930s in terms of stock market. That's all that matters to me.
Yeah.
And then I tilt over the commodities. I see deflationary trends in natural gas, in crude oil, in corn, in all the demand metrics I point out from a commodity standpoint. And then we have things like the yield curve that's still inverted.
Right.
We have things like leading indicator that's still negative. But those things are not going to matter until the stock market goes down, makes everybody shift their attention over to that, and it'll matter. And that's what I think finally bids gold up because it'll shift those outflows and ETFs to inflows.
Absolutely.
And there's no risks in making predictions like that.
Oh yeah, absolutely. And hey, it's such a huge pleasure having you come down to Wall Street Silver, Mike. Always talking about the markets. It's always like a huge, huge pleasure. So thank you so much for coming down to Wall Street Silver. And hopefully, as the market develops, everything that's happening with gold, silver, oil, commodities, we'd love to have you back on.
Well, thank you. I appreciate the one enduring trend in commodities that I've observed over time. I think it's going to accelerate this year. This year is that gold to crude oil ratio, WTI crude oil. Right now, it's around 30 barrels of crude oil per 1 ounce of gold, and it's coming back a little bit today as we record on May 28th. But to me, that's just one of those things that's probably going to accelerate by the end of the year, and we'll see what trips up my view on that one.
Yeah, exactly. We'll have you back on very soon. So see if your predictions are
Okay,
correct. Talk
thanks
to you
for having
soon,
me.
Mike.